So welcome everybody to this next panel. Why do we think it is that discounts have widened?
We're going to solve it in the next 45 minutes. Why have discounts widened? I would step back and say it's factors of supply and demand. And I mean, that there are structural, there are cyclical things going on. Some of them are quite long-term in nature. So, I mean, structural things, regulation, cost disclosures. I can think of how many acronyms have we had over the past year in relation to sort of, say, past decade in relation to regulation, like audio or MiFID, PRIPS, kids. That there's been a lot of sort of structural things going on, not all of them necessarily positive. You've had, again, long-term evolution in the shareholder bases away from when I started insurance companies, in-house pension funds, local authorities. So that's rotated over the years more towards sort of private wealth community and increasingly the sort of retail platforms. You have another structural issue, competition from passive investments. So you've got to compete with an asset that's appears cheap and simply sort of replicates indices. And obviously cyclical issues, the sort of markets, economies moving in cycles. So the inflation rate story over the past couple of years is probably the most obvious sort of example of that. You've had investments that were possibly owned by people for some reason because they had a high yield, and now with sort of gilt yields at 4.5%, 5%, there's not a competition from an easy alternative to own. And of course, when things move in cycles, sort of value growth, large cap, small cap, UK overseas, defensive cyclicals. So there's reasons why discounts on certain things move in and out of favor. And of course, asset class specifics. Look, a lot of the private equity trusts, and in that world, there's been some skepticism about the validity of NAVs. Are they behind the curve? So, in certain asset classes, I'd say that there's structural, cyclical, and sort of asset class issues, and the big ones are where we are with rates and inflation, and where we are on the sort of cost disclosure front is probably the other big thing that's been impacting demand recently, seeing discounts possibly widen a little bit.
Anything he's missed?
Well, I was about to say, I mean, I might as well go home because I think Bernard's pretty much covered it. I think the other thing, Bernard's right, it is this differential between supply and demand, and there are various reasons, short-term and long-term. Short-term, obviously, rising interest rates, in response to rising inflation expectations are the sort of big issue. Longer term, there are all these sort of structural things that Bernard has referenced. The sort of one thing, and I know this has been covered earlier in the day, is obviously the consolidation in the wealth management industry. So Bernard touched on a little bit, but it is this sort of change in the buyers versus the sort of sellers, and it is much harder for sort of investment trusts to meet the necessary, sort of minimum size requirements as wealth managers consolidate.
I think that's it. I think it's a sort of absence of the marginal buyer. Yes, Matthew said it. That's really impacted on the sort of wealth management side by that consolidation.
You've got the sort of inside edge from the broking point of view. How much selling is being driven by the wealth managers?
I wouldn't say necessarily a huge amount per se, but there's certainly not the sort of marginal buyer there. I think certainly in the alternative space, a lot of the selling has been as a result of retentions. You see it also a lot with these. There's always a drive for bigger, more liquid funds, but a sort of one of the sort of negative points of that are you sort of in the FTSE 250 at the whim of the sort of passive market, and you've seen a lot of passive selling as well of these vehicles. So I think there's been numerous factors at play.
Fair enough. Now, the charges one is one that the AIC has put a lot of effort into trying to address. Charges disclosure. Do we think generally charges are too high anyway across the investment companies industry, or is that company by company thing, or are they about right, Matt?
I mean, I think it's a sort of company by company thing. You look at certain asset classes, and clearly they're going to take a bit more money to run. I mean, if you've got a sort of straightforward UK equity income fund, and you compare that to an infrastructure fund or a private equity fund, the sort of levels of due diligence and the transaction costs associated, they're just going to be more expensive to run. Well, I think you sort of got to take that into account, and you've got to expect that. But I think, as we were sort of saying earlier in the private equity piece, when you're looking at performance, invariably you're looking at this after the costs anyway. But I think when you look at alternative products, people tend to sort of focus on the high level numbers, and they're not really digging beyond that. So it's easy to go, well, actually, the investment trust, once you look at the through costs, if on a piece of paper somewhere it says that it's sort of higher than perhaps it should be, people just focus on that. They're not digging into the detail. I think that's why actually that is an important change we need.
Yeah, I am starting to worry that because of kids and PRIPS and things, all these disclosures, that it's becoming ingrained in retail investors' minds that investment companies are expensive.
Yeah, I think that's
well, that isn't necessarily true. Yeah. We talked a bit about the wealth managers. One of the things that they keep pushing for is mergers, making funds bigger, improving liquidity that way. Do you think that's a panacea for stopping them selling?
I don't think so per se. I mean, I think there's a drive to sort of bid on more liquid trusts, but if you look at the market, it's not really there's not a size premium sort of being reflected in the ratings. If you look at some Green Coat, Trig versus some of the smaller renewables, the solar funds, or some of the downers of this world, they're all on big discounts. So I think M&A is helpful, but it's certainly not on panacea, and doesn't automatically mean you sort of re-rate on the back of it.
Is that something you concur with, Bernard?
Yeah, I mean, and M&A can bring certain advantages. Larger funds can help at the margin reduce the ongoing costs. Being larger should be more liquid, should be easier to trade. So there are some benefits, and usually those M&A activities, bringing two funds together, there's usually some sort of exit for some shareholders, so you can improve the overall, diversify the shareholder register on those vehicles. So it's something we're seeing a little bit more of.
Is there a size that's too small, do you think that?
I think once again that depends on the asset class, and certainly for wealth managers, clearly a lot of the small stuff. And that's where you can get some really interesting opportunities, but they just can't go there. And I think the other sort of problem you've got, I don't pretend to be an expert on sort of wealth managers or on wealth manager consolidation, but given some number of small outfits, that looks like that could still have a sort of good way to run. And if you sort of take a step back from that, you have to ask yourself the question, if you get to the end of that consolidation, what would the minimum size of clump be anyway? And actually, the other problem you've then got is, does anybody end up with something that looks like a sort of market return? Okay, where is the room for decent active strategies at that point?
It is interesting, I think, is that if you look at some of the more established equity funds in particular, then those shareholder bases are mostly retail. And they're not really so worried about size. I mean, they're obviously worried about charges, and they're worried about ongoing charges, and smaller funds are generally more expensive to run. But they're not so fussed about that. One of the things that they do keep telling me is that there's a problem with spreads. No, I mean, looking at the broker here again.
I think it's I think over the last sort of couple of decades, in terms of the sort of market making and capital that banks are committing to, not just this sector, but broadly sort of trade, and that's obviously reduced significantly, and as a result you've sort of seen spreads and liquidity.
I'm sorry.
Sorry. I think I think over the last sort of 10-20 years you've seen banks sort of really reduce the amount of capital they're committing to market making, and I think that has been impacted in liquidity and ultimately spreads. So I think it is an issue, but you've seen that sort of move away.
Is that a permanent shift in terms of availability of capital, or is it something that just reflects the economics?
I think it really reflects the sort of change in the regulatory environment of the last decade post financial crisis. The sort of cost of providing capital, it's just increased significantly, the regulatory cost, and that's also not helped by the sort of moving rates of the last year.
Yeah, fair enough. So I mean, given all these things, I suppose the question is, are discounts really fixable? I think we probably have to go by type of fund rather than trying to think of it across the whole piece. So I mean, I put that chart up at the beginning of this, and if you weren't in the room then, you'd probably go back and have a look at it. But basically, the story is that we have seen a derating across the whole industry, but it's been very much more severe in alternative assets than it has been in equity funds. But equity funds are still on wider discounts than they were 5 years ago. So what can, bog standards the wrong way of move, what can a typical equity fund do about its discount? Start with Bernard.
I think there's a number of things you can do to try and generate a little bit of excess demand. And the first thing I think every board, every management company should be thinking is, how can they make the trust as compelling a proposition as possible? Is the remit right? Is the strategy you're employing right? Is the manager the best manager to deliver that? We touched on fees. Are the fees competitive? When did you last sort of do a peer review on that? Is the manager using the structural advantages of the sort of investment company vehicle to take a longer term review, to seek out illiquidity premia? Are they using gearing in a sensible manner? Are you trying to attract income focused investors? Your dividend approach, using the sort of benefits of the investment company structure to deliver that. And also, I mean, how you're going about promoting the vehicle. You still see some fact sheets, materials that are infrequent and not that high quality. So is what you're putting out high quality, easy to access? Have you got a social media strategy, or are you go on your website? Does it look nice? Does it feel nice? Can I find what I want easily? What are you doing in terms of press coverage, advertising? Are you working with someone like QuotedData to help bring the vehicle to as wide an audience as possible? So there's various demand things, and I suspect we'll touch on the supply things in a minute or two that you could do.
Well, on the supply side of things, I mean, how aggressive should people be being about buybacks? We're talking about equity funds now.
In terms of this, does it necessarily help narrow a discount over the long term? I think the jury is probably out on that. Does it have other benefits in the short term? Well, it's immediately NAV accretive. If you buy 10% of the shares and a 20% discount, there's roughly 2% NAV accretion. That's immediate, it's risk-free. But it can help lower your discount volatility. We talked about spreads earlier. It can narrow the trading spread. It can mean there's someone if you need to sell, that there's someone there on the other side to buy those shares. And I think it demonstrates a board that cares a little bit about the shareholder experience, shareholder returns.
Matt, did you talk to sort of Peter Spillers of this world, Capital Gearing? They would say that most of these equity funds should be able to aim for like a zero discount policy. Do you think that's reasonable, achievable?
I think that can be quite challenging. I think you've got to look at the underlying asset class, even with sort of broader equities. The stuff's a bit more small cap, it's more niche, let's say small cap mining. You've got different liquidity profile to what you have if you say you're like large cap global equities. And I think that sort of is definitely part of it. I think in terms of actually, getting discounts, now once again, Bernard, I think, has sort of covered the main bases, but I think anything that actually makes it increasingly shareholder friendly will improve it. So once again, look at the fee structure. The other side of that is actually fees have got to be an appropriate level to incentivize managers. And performance fees are much less in fashion. I think that's probably a good thing because they can be sort of harder to understand. But actually, are you paying the manager enough to make them want to go out of bed and actually sort of do this properly? And sort of come back to repurchase, there are limits. Let's say smaller fund. If you are an Alliance Trust as well, I think they've done a really good job. They've had a really clear discount target and they've defended that 5%. It's worked very well and they've got the size to do it. That's not a problem. But if you're a sort of smaller fund, there are, I suppose, a vicious circle. they're ever decreasing returns to buyback shares because you are starting to fall some ongoing charges, which we said everybody's looking at. And actually, you're taking shares out of circulation, so you are effectively reducing liquidity over the longer term. And there is that sort of balance between short-term and the long-term considerations here.
I mean, you talked about Alliance Trust. One of the things that it's done is sort of more, and it's not an explicit target, but roughly it's sort of 5%-ish. And some funds that they can set an explicit target. I know Widened did years ago. It was like 8%-ish, and it worked. The shares immediately moved up to trade at that level. Do you think more funds should be doing that?
I think there's a strong argument for it because the proof is needed. Once again, of course, you have to have sufficient liquidity in the underlying, even if it's an equity fund, to be able to do this. So if it's larger cap equities, that should be sort of fairly straightforward to do. And I think more funds could do that. I think there is a sort of advantage, perhaps on an ongoing basis, to defending a sort of small discount because, of course, it remains now accretive for ongoing shareholders, which is quite nice and simple.
Cool. Now, one of the things that was sort of in vogue a few years ago, when everybody was coming for income and it was quite hard to come by, was, okay, well, we'll pay a yield that wouldn't normally exist. We'll pay a yield on capital. Do you think, Ben, for example, do you think that actually makes a difference?
I think in certain cases you have seen it. I mean, Bernard will know better than me, but a number of private equity trusts have looked to sort of manufacture a yield. I sort of predominantly look at the alts, and there we sort of always try and focus on covered dividends and dividends that are sort of appropriate for the underlying asset class, and where you've not seen that, say Digital Man most recently, these companies have gotten into real difficulty. But I think it can work, and if you do have a sort of pretty liquid portfolio that you can turn over and manufacture a sort of yield, it can be beneficial, and certainly, I guess, over the last decade where yield has been scarce, it's been, I guess, welcomed by investors.
Is that something you agree with, Ben?
Yeah, I mean, you just referenced the private equity trusts. A number of them do pay sort of 5% of NAV, which current at the discounts are on. You're getting sort of 6, 7, 8% dividend yields out of some of them, but it's not necessarily being rewarded with sort of discounts that have around. Still sitting out on between 20 and 40% discounts at the minute, despite the returning capital via dividends.
Cool. I've got quite a lot of questions that relate to alternative assets, but maybe before I chip in with those, maybe just ask a few people questions in the room. Anybody?
So I'm not quite sure how to phrase this. Is the premise of this discussion, starting off on the wrong foot, solutions to the discount problem? I haven't heard one person say, as far as attracting retail customers, which is what you'll want to do, haven't heard one person say that there is actually a discount problem or what that problem is. Now, perhaps it's just I come from a retail background, but if I turn around to my clients and say, well, we've got some of these wonderful unit trusts looking at UK equity there, they look like they've sort of over the worst now, they're starting to come back a little bit. We've also got these UK equity funds, which are trading at a 40% discount. And as soon as the markets pick up, their discounts are going to reduce as well as their asset values increasing. This is a wonderful opportunity to be going back in. And yet everyone I've heard talking data, oh, it's doom and gloom. We're facing the end of the world. The regulator wants us dead. The clients don't want us. The pension funds don't want us. The Americans want us to go to ETFs. So I'd like just to the panel, I say, actually, what is the problem apart from, perhaps fees are related to actual value and so on. But the question also, one or two people mentioned that as the discounts have been getting larger and larger, when they're having redemptions, using the money to buy back shares, that seems an ideal option as well. It's something which a lot of small funds and venture capital trusts do all the time when they have redemptions before the minimum holding period has been met. The the problem isn't perhaps as big as it's being made out to be, and perhaps people aren't looking at right solutions. And if part of that solution is to attract more retail customers in good times as well as in bad times as well as good times, perhaps also part of it comes down to having a greater emphasis on trying to interest and train the people involved in the retail part of the whole investment UK business. I know a lot of other IFAs who just out of hand don't look. The only investment trust they look at are venture capital trusts because of the tax breaks, and they don't look at anything else because well, it's always bad when you can have an asset that's worth £1 million and you can only sell it for 800,000. It's an added complication when markets going down. But equally, I say there just seems to be a number of questions and starting off on the wrong foot. So and that's probably just my naivety because I don't do a great deal of investment trusts, which is why I'm here today.
Yeah. No, honestly, I think you've hit one nail on the head, really. I think it's quite hard for us to stand here and say you should just ignore the problem. I think, though, for a lot of people, if the experience has just been this has always traded at a trade discount, it's not going to make an awful lot of difference to you if it carries on doing the same thing. I think the problem has been a lot of funds have been launched recently at asset value, and they're now trading at 30-40 discounts, and that's a serious loss on top of whatever's happened to the NAV. Actually, quite often the NAV hasn't gone down, but it's still you're sitting on big capital losses, and that's what's getting people exercised. So there's an element to which the problem is volatility in discounts rather than the absolute move, but where you've been issuing new stock that's gone to a discount, then I think that's a problem. And you could levy that at something like a Scottish mortgage, which issued billions of pounds worth of shares at a pretty small premium to asset value and is now down towards a 20-something discount. Should they be more aggressive about solving that problem now because they've let that problem arise? Or is it just a fact of life that we should just get over? I think on the alternative asset side, what we've seen recently, though, because these discounts are opened up, is you get opportunistic bids. So for a manager, suddenly your entire fund's disappeared. That's probably quite, that means they probably do not get a bit focused about that.
I think other investors get annoyed about it as well, because you do see assets get snapped up at, in some cases, quite shocking valuations. And it's a slightly different sector because obviously bid on property forum. But I think the sort of bid for Civitas social housing that was a big discounted anyway. I think a lot of investors were not happy with that, but clearly not enough because it got approved and the board approved it in the first place. And somebody was saying earlier about board stepping up. I still don't really understand why that was approved and went through. That is still a bit of mystery. I mean, if anybody's got an answer, I'd love to know.
Exactly. So to the extent that maybe the problem is actually probably more in the alternative asset space, I think, to what you're saying. And I do think, because Bernard's already talked about marketing, maybe the education, this is a great opportunity to pick things up at bargain prices, and that needs to be done more. But, so, if you've got an asset class that is quite inherently liquid, and you can't fund buybacks that easily, what's the answer? Do you want to kick off, Ben?
Yeah, I think ultimately in this environment, the discounts are a function of a number of things, macro, rates, inflation, but also, there's a bit of skepticism over NAVs and have discount rates moved enough, and that's ultimately reflected in the share price. So I think, in my view, to the extent companies can sell assets at or around NAV, prove the valuations, they can use, and then use that manufacture to sort of generate capital. I think in this environment, cash is king. Use that capital to either buy back shares, but in my view, probably delever expensive RCFs first, and then buy back. And again, it's not share buybacks on sort of panacea, but I think it has other benefits, as not just sort of managing your discount.
You agree with that?
Yeah, focus primarily on the sort of private equity trusts, and yeah, we're continually seeing those funds make realizations at or above, usually well above carrying values to provide some validity to the NAVs. So that's one positive to the story. Not necessarily helping narrow the discounts in the short term, but they all seem to continue.
Can we ignore it? I mean, it's one of the things that I picked up in an article the other day. Is like property funds seem to be prepared to ignore it. This is just a normal fact of life. You get excitement in the property sector, things trade. I see we raise a lot of money off you, and then interest rates change or whatever, and they go to a discount. They're not looking like they're trying to do anything about it.
Yeah.
And nobody seems to be kicking off so much in the property sector.
Yeah, I think there's an interesting phenomenon. Maybe Bernard's sort of best place to comment on this as an investor. But it's got to be frustrating when you say you raised an asset value or close to whatever, and then you do get these opportunistic bits, because they do come. Maybe a few sort of far between, but they do come. And actually, a lot of assets have left the sector at quite heavily discounted values. I think if you're a fund manager investing in it, that is particularly annoying. I think so one way, if you've not got the money, it's fine if you've got the money, some sort of fund repurchases or other uses. One thing you can do is increase your market value. If you've got a good story, get out there and beat the drum. If you think if you're trying to raise money, it probably costs you about 2%. That's usually what the fees are capped at. In terms of actually, I know so many funds quite rightly are very conscious of their expense ratios, etc. But actually, you end up spending a sort of fraction of that to keep money. And I think perhaps it needs to be reframed in that way.
Yeah, maybe. What about periodic liquidity? It's another thing that's been suggested from time to time. That every 5 years, every 7 years, you let people out, or let people go into a realization bucket. Would that be attractive, do you think, Ben?
Certainly has been for a number of funds that have launched over recent years. In the listed equity funds, I can think of quite a few issuances that have that. It is helpful as at IPO, as it overcomes one of the hurdles that potential investors are going to have, which is what's to stop this fund trading at a significant discount? What are you going to do? So having that backstop there from the outset on certain funds, depending on what the underlying assets are, certain regular windows can help you. Absolutely.
But how aggressive should they be? We've got a couple of clients that do this. Some of them let you out 100% you're holding quite on a really regular basis. Some of them it's much more, 5 years, whatever. One of the things that I worry about with those 100% exits is that you can see a whole fund disappear just because everybody's having a bad day in the market that week.
Yeah.
Is there a sort of right size to do that sort of thing with?
It's obviously risky if you're doing it a 3-year or 5-year windows, and you get a really bad time in the market. You have whatever a COVID or a war in Ukraine that happens that month. Yeah, it can kill you. Yeah, absolutely. So there is a risk. So it's like everything. Not everything is all positives or all negatives, but that's
cool. More questions from the audience. There we go. Maybe here.
Hi. Just following on from that, can I ask you about tender offers? If we look at the people who normally take up tender offers, they're often the institutional investors in any given trust. Retail investors may not necessarily get access to or see those tender offers either in good time or have sufficient information or really understand them. With consumer duty in mind, can you just give us your thoughts, please, on the attractiveness or otherwise of having tender offers, which would result in the shrinking of a trust and potentially leaving it unviable under consumer duty considerations?
Matt, do you want to go at that?
I do. I think that's a very difficult question. I was probably throw that at Ben. But no, I think that is a challenge. I know there's a number of IFAs in the room. I spoke to a few of them today, and they find all of that particularly onerous. I'm not sure that we're necessarily the sort of best crowd to answer that question. But it does come back to the fact that sort of regulation has become more and more onerous, and tender offers are sort of quite challenging to administer. And I think, everybody should be getting equal access to things. It doesn't just apply to tender offers. I think that's probably something that sort of very much needs to be addressed across the board.
Yeah, when it was IPO issuance and secondary issuance, one of the things I was concerned about was that retail investors weren't getting a fair look in.
No.
So it works the other way.
Yeah, and I think that particularly the issuance, that is frustrating. You're right, this applies on both sides. You suddenly sort of find that these offers have opened and they've shut, within 24 hours, and it's all been placed in institutions. And you have to go, that wasn't really fair on retail, if they are the future.
Which they are.
Which they are, as we would agree.
So there was another question over here. So,
Yeah, so I've noticed there's a couple of Aberdeen property trusts which are on substantial discounts, excess of 30 or 40%. They're fairly liquid assets. So is there a reason why there's no share buyback or something, mergers perhaps in the future?
I don't know if you answer it, but it's probably not your.
Yeah, I'm not involved with the Aberdeen Property Trust. I invest in closed-end funds for other strategies, so I don't know the specifics of those funds. I do own one of them personally, so I'm a investor in one of them. I can't really comment on what the internal Aberdeen thinking on those vehicles is.
Are you happy to say which ones they are that you're looking at in particular?
So one of them was Aberdeen Property Income, which I believe is on about 40% discount.
Yeah, that's Jason Bagley's fund, if I
Yeah,
remember
the
rightly.
size is about 200 million, which is obviously small, but I believe they're fairly liquid assets that could be liquidated within hours, I imagine.
I would probably dispute that. I like that. I think it's sort of well managed. I think Jason has been pretty innovative with some of the stuff that he's done. For example, buying the sort of woodland or managed woodland to offset carbon credits in the future. I think that was actually sort of quite shrewd, assuming that, and it looks like it's going to work, but assuming that it does work, that could work well. I don't see how you would liquidate, none of those assets are listed. I don't know how you would liquidate those in a number of hours. I mean, they'd all have to be sold piecemeal, and you would have to obviously get both sides, lawyers to look at it, et cetera. So rather than hours, I think you could. It's probably one of the better portfolios to liquidate, but I still think it would probably take, I'm going to guess, 6 months if you rushed it. But, you probably need to ask Jason.
It's so illogical that they're on a 40% discount.
It is.
I think the market might have got it completely wrong, maybe.
I think the same could be said for, a lot of these alternative income funds. And you sort of take a step back, of course, in an environment of low interest rates. A lot of sort of traditional fixed income investors moved into these spaces. A lot of these funds were able to expand because of the sort of dearth of yield available elsewhere. And I think you're sort of seeing that imbalance reflected now. And I think, it has almost certainly created some superb long-term opportunities. Now, what is the catalyst for re-rating? We probably spent a large part of the afternoon sort of debating that, certainly, when there's some kind of signs of inflation having peaked and their interest rates having peaked. And there are signs of this on the other side of that. But actually, what then makes these things come back closer to asset value? It's difficult to tell at this stage.
Question there.
Yeah, it's probably it's worth bearing in mind that we're looking at investment trusts here. And actually, if you look at operating companies, which is similar but different, and the PE of the UK market's on, I don't know, 13. Well, has traditionally been on a historic basis about 13 times. At the moment, it's on about 10 times. Give or take some bad maths, but 30% discount. And you're looking at an operating business that has an intrinsic value of X. It's probably trading at a 30% discount to that. We're looking at NAVs, and because you can see an actual NAV rather than an actual intrinsic value of an operating business, there isn't so much difference between the two. It's just that you can see what a NAV is and you can see what a share price is, and therefore it's a very clear mathematical calculation, whereas it's harder to actually see that for an operating business around what that actual intrinsic value is. Clearly, we know what the share price is. So when we think about investment trusts, they obviously don't operate in a vacuum versus the rest of the UK industry. Actually, when you think about the UK industry, then actually a lot of the issues that we are talking about here are actually pertinent to the wider UK investment savings market. So I think we should just put that into context, like to what the gentleman was saying up there, that yes, it is an opportunity, but it's an opportunity that extends beyond investment trusts, so I think to the entire UK market.
Cool, thank you. Online questions.
There's a couple that have come through online. The first one, there's been a considerable amount of consolidation in the industry over the past year. Do you see this as a positive or a negative?
Let's take that. To Ben, when you
Is that any underlying? I think in the actual investment company space, yeah, it's positive. I think there's a desire for bigger, larger, more diversified companies that we can see M&A. I think that will generally be welcomed. I think we've seen the last sort of decade a lot of a number of IPOs, some more successful than others, but I think there's my view is that there are too many sort of, as my colleague Alan calls them, zombie investment trusts that need to be sort of wound up or merged into other vehicles to be made more marketable.
Cool, thank you.
One more on the discounts. Do you think there are some sectors where discounts are more appealing than others?
I'll start that. I mean, I think renewable energy is a really obvious one.
Yeah.
Like, it's just gone crazy. It doesn't make any sense to me at all. You've got assets that we all need, that we need to invest an awful lot more money into. Offering you yields of 7-8% that are growing. Inflation-linked revenues, like none of it makes any sense to me. And evidence that the values are real. That's crazy. There we go.
Yeah, I think that would probably be my top pick as well. You could probably throw, sort of infrastructure and private equity in after that. But to come back to renewable energy, you're quite right. We need so much of this. The opportunity is huge. And we're not going to be anywhere near capacity anytime soon. So, the return profile should still continue to be strong from that. What's not to like, really?
Bernard, do you want to pick one?
I look a lot at the listed private equity trusts. There are some very good vehicles there that have been for decades, that have portfolios that are performing strongly, with the manager still continuing to make exits above carrying values, that have high dividend yields, and you can buy these on discounts 20, 30, 40% in some instances.
Yeah, I think I agree with you, James. I think my sort of top pick is the renewables. You can see the sort of cash flows coming through are very predictable. You can model them. The disclosure is pretty good. They're generating significant amounts of cash. Dividends are well covered, so I think they're well placed. At the margin, favour those over sort of social infrastructure stocks, but I think they look pretty good value, and I think importantly, all the sort of renewable, typically most of them anyway, operationally they're all performing pretty well. Fundamentals are good. It's just a sort of macro backdrop that's obviously impacting. In the stock side, we like the sort of, I guess, more growthy infrastructure plays, the 3i infrastructure and Pantheon infrastructure. Again, to the extent you can get those on meaningful discounts, but I think they deliver pretty attractive returns on a long-term view.
Great, thank you. Question there.
Just one quick question stroke observation. Actually, Charlie's point about comparing investment trusts with operating companies made me think of something else, and that is where management of operating companies are incentivized, they're often incentivized on the share price of those companies. Whereas where managers of investment trusts are incentivized, they're incentivized on NAV. So is there an argument that management fees should be charged on market cap and not on NAV? That might focus the mind a little bit. And the second point to make is when you're talking about incentivizing managers of private equity vehicles, they should always be incentivized on realized assets rather than on mark to market. So that when performance fees are paid, they're paid on real values rather than on hoped for values.
I mean, I would agree with all of that. Just on the management fees, I think my preference is for the lower of NAV or market cap.
Yeah, exactly. No point dragging up to the larger premiums
Yeah.
and more money.
Yeah.
Okay.
Sorry, I was just going to make an observation. I mean, I don't know whether the panel agree, but I mean, one of the problems in terms of discounts is actually boards and arguably managers are being asked to sort of sort out, quotes, the discount problem. The discount problem is actually created by the market makers and the brokers, because they're the ones pricing it, and they're pricing it because they're on a fixed match bargain basis. And you know, they get nervous about amounts. I mean, I've seen trusts on discounts of 15, 16%. If you wanted to buy £100,000 worth of shares in them, you couldn't get them. The price is a different one. They come back with a completely different price, which is probably 5 discount or 4 discount. I mean, this is the problem, you know, and you sit there suggesting that managers get paid on market cap. Well, you know, managers are there to build the NAV, to grow the company, and that's why the fees are on NAV. You started charging them on market cap, it's because of what these bloody brokers are doing. So, you know, what the brokers, we need to think about how you price.
How you're using the wrong broker.
how you price shares. But no, you guys are all the same, and it's you know, you start doing share buybacks, you know, and what happens? You get broked against. You know, as soon as the brokers see the other side of the deal, great, let's encourage everyone to sell. You know, it isn't really that brilliant. I mean, I think the discounts are part of life in the investment trust sector. And the private investor really doesn't worry about it. The private investor looks at the yield they get, and the private investor looks at what the value of their investment is, and they don't really worry too much about the discount. And I've seen trusts on team discounts win continuation votes year after year after year. So it does happen. I think we could get overworked up about discounts, but I do think we need to think about how shares are priced, because I think that's where the real problem is, because discounts are widened and then they're not actually relevant. It's actually an advantage for private investors, because private investors can generally buy shares at these wide discounts. Professional investors can't, because they're buying in a bigger size, and the bigger size, it's always different. It's the same thing around liquidity of investment trust shares. You know, is there a liquidity problem in the investment trust sector? The answer is no. It's just that people don't like the price. You know, you can always buy 5 million shares in something, and it won't be at the price you want it to be. So, you know, I think that it's a much deeper problem than people imagine. And I personally think it's unfair that everyone looks to boards to solve the problem, because actually, in my view, they're not boards that are causing the problem. Although I absolutely accept, you know, you've got bad performing funds, it's likely to have a wider discount. Good performing funds is going to have a narrow discount. But, you know, at the end of the day, it's actually looking at what is your manager doing, what's the yield, and what's the NAV.
Cool. Thank you.